The noise is deafening. Every single day, 1,000 voices scream for your attention, each one armed with a breaking headline, a hot stock tip, a dire prediction. They tell you what to buy, when to sell, why the market is about to crash, why it's about to soar to new heights. Financial news networks run a constant ticker tape of green and red arrows, a hypnotic feed of information designed to trigger your most primal instincts, fear and greed. Analysts on television argue with the conviction of prophets, armed with charts and graphs that promise to unlock the market's secrets. And in this chaos, the average person, the aspiring investor, the individual trying to build a future, is left feeling perpetually behind, perpetually anxious, convinced that the key to wealth building is to be faster, to react quicker, to somehow process this fire hose of information more effectively than the next person. But what if this entire premise is a lie? What if the race to react is a loser's game, designed by the very system that profits from the churn and the chaos? What if the real secrets, the genuine, multi-million-dollar advantages, are not found in the flash of a news alert, but in the quiet solitude of a library, hidden in plain sight, in documents so dense, so deliberately boring, that 99% of investors refuse to even look at them? This is the central truth of Warren Buffett's entire philosophy. It is the bedrock upon which the $90 billion Berkshire Hathaway empire was built. When asked about the key to his success, he once held up a stack of reports and said, "I read 500 pages like this every day. That's how knowledge works. It builds up, like compound interest. All of you can do it, but I guarantee not many of you will do it." This isn't a pithy quote. It is the genetic code of his methodology. He has engineered a system of investing that renders the daily noise of the market utterly irrelevant. His informational advantage doesn't come from a faster data feed or an inside source on Wall Street. It comes from a deeper level of understanding. He achieves this by going directly to the primary source, the annual report, the 10K, the unvarnished, legally mandated disclosure of a public company. He reads these documents not as a collection of numbers, but as a detective novel. He is searching for clues, for the narrative of the business, for the character of its managers, and for the subtle hints of a durable competitive advantage that the market, in its manic depressive frenzy, has completely overlooked. The costly mistake this approach prevents is the single greatest destroyer of wealth for the average investor, making critical financial decisions based on second-hand information, on sensationalized headlines, or on the biased opinions of analysts who may have their own agendas. By learning to ignore the noise and decode the primary source, you insulate yourself from the herd mentality. The financial transformation is profound. You move from being a passenger, tossed about by the whims of the market, to being the pilot, navigating with your own map, your own compass, your own deep fundamental analysis. You will learn to find the million-dollar clues hidden in the footnotes, the undervalued opportunities buried in the management discussion, and the critical risks that everyone else is ignoring. This is the path to true financial literacy, to becoming a confident, independent, do-it-yourself investor who can build lasting wealth not by chasing the market, but by systematically and deliberately beating it. Our journey today is to deconstruct this master skill. We will not just talk about it. We will dissect it, reverse engineer it, and build a practical blueprint for you to apply. We will explore the 5 fundamental pillars of this detective approach to stock research. First, we will establish the core philosophy, the mindset of treating every share of stock as a piece of a business, sourced directly from the company's own words. Second, we will uncover the tactical art of reading these reports from back to front, a technique designed to bypass corporate marketing and get straight to the unvarnished truth. Third, we will learn how to use these documents as a treasure map, searching for the signs of an economic moat, the durable competitive advantage that is the true source of long-term compounding. Fourth, we will analyze how Buffett reads between the lines to judge the character and competence of management, understanding that he is betting on people as much as on balance sheets. And finally, we will explore the defensive side of this skill, how to use the annual report as a diagnostic tool to uncover hidden risks and red flags, protecting your portfolio from the catastrophic losses that wipe out years of gains. This is not a get-rich-quick scheme. This is the real work. This is the foundation of an investment analysis framework that can serve you for the rest of your life. A portfolio strategy built on knowledge, not speculation. Pillar 1 of this entire framework is not a tactic or a trick. It is a fundamental shift in perspective. It is the philosophy of the primary source. This pillar represents the conscious decision to build your entire understanding of a potential investment on the foundation of the company's own legally mandated filings, principally the annual report and the quarterly 10Q. It is an act of deliberate intellectual independence. It is the choice to become a business owner, not a stock speculator. It means you reject the cacophony of market commentary, analyst ratings, and news headlines as your starting point. Instead, you begin your due diligence in the quiet, focused environment of the document itself. This mindset is about recognizing that the market is a swirling vortex of opinions, emotions, and narratives, most of which are derivative. The news reports on the stock price, which is a reflection of market opinion. The analysts report on the news and the price, adding another layer of interpretation. By the time information reaches you through these channels, it has been filtered, spun, and emotionally charged. The primary source, the 10K, is the bedrock of reality beneath all that noise. It is the company speaking for itself in a format that it is legally bound to make as accurate as possible. To adopt this philosophy is to say, I will form my own opinion based on my own stock research before I allow the market to tell me what I should think. This is the first, and most important, step in separating yourself from the herd and beginning the journey of an informed investor. There is perhaps no greater story to illustrate the immense power of this philosophy than Warren Buffett's masterful handling of the American Express salad oil scandal in 1963. This single episode is a perfect microcosm of his entire approach, a demonstration of how ignoring market panic and focusing on primary source reality can lead to truly extraordinary returns. The context is crucial. In the early 1960s, American Express was not the diversified financial giant it is today. A huge and supposedly safe part of its business was in warehousing. Specifically, its subsidiary, American Express Warehousing, issued receipts for inventory held in its warehouses. Other companies and banks would then lend money against these receipts, believing the underlying collateral, the inventory, was safe and sound under the watchful eye of American Express. One of American Express's biggest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis. Allied took out massive loans, secured by American Express receipts, for what was supposed to be a colossal amount of salad oil stored in their tanks in Bayonne, New Jersey. The problem was, Tino DeAngelis was a con man of epic proportions. His tanks were mostly filled with seawater, with only a thin layer of salad oil floating on top for inspectors to see. For years, he ran a massive fraud, fooling auditors and securing hundreds of millions of dollars in loans, in today's money, billions, against phantom inventory. In November of 1963, the house of cards collapsed. Allied Crude Vegetable Oil filed for bankruptcy, the fraud was exposed, and Wall Street was thrown into a state of absolute panic. The central question was, who was on the hook for the worthless receipts? The banks and lenders who had loaned money against the phantom oil claimed that American Express, having issued the receipts, was liable for their losses. American Express stock, once a blue-chip darling, was decimated. The price plummeted from over $60 a share to $35 in a matter of weeks. The headlines were brutal. The news was filled with terrifying words like fraud, bankruptcy, and unlimited liability. The prevailing narrative, the story screamed from the television and the newspapers, was that American Express was facing losses so catastrophic that it could be forced into bankruptcy itself. The herd was stampeding for the exits. This was a classic market panic, driven by fear, uncertainty, and a terrifying narrative. The 99% of investors, the ones who follow the headlines, saw only one thing: a reason to sell at any price. But Warren Buffett, operating from his small office in Omaha, Nebraska, saw something different. He saw a disconnect between the market's narrative and the potential underlying reality of the business, so he refused to listen to the noise. He initiated his own process of fundamental analysis, starting with the primary sources. He obtained American Express's annual reports. He studied their balance sheet, their income statement, their business segments. He saw that the core businesses, the traveler's checks, and the credit card division, were immensely profitable and growing. These were powerful, world-class franchises. The question was whether the salad oil liability was big enough to sink this otherwise magnificent ship. The market was screaming yes. Buffett's approach was to find out for himself. He didn't rely on legal experts quoted in the Wall Street Journal. He did his own due diligence. This went beyond just reading the reports. He embodied the, quote, business owner mindset. He started walking into restaurants and travel agencies in Omaha. He talked to the cashiers and managers, his own form of primary research. He'd ask them if the scandal had changed their willingness to accept American Express travelers' checks or credit cards. He'd ask their customers the same questions. The answer was resounding no. People still saw the American Express brand as a gold standard of trust and security. They associated it with travel and prestige, not with vats of fraudulent salad oil in New Jersey. He then went to local banks and asked them the same questions. Were they still selling the traveler's checks? Yes, more than ever. He discovered that the scandal, while a massive reputational hit in the financial world, had barely registered with the end consumer. The economic moat around the core businesses was not only intact, it was completely unharmed. He combined this on-the-ground research with a deep dive into the company's financials. He calculated the absolute worst-case scenario for the salad oil losses. He determined that even if American Express had to pay every single claim, the loss would be significant, but it would not be fatal. The earning power of the traveler's check and credit card businesses was so immense that it could absorb the hit and recover within a few years. The market, in its panic, was pricing the company as if its entire franchise was permanently impaired. Buffett, by focusing on the primary sources, the financial statements, and his own direct investigation, realized the market was confusing a temporary, albeit very large, problem in one division with a mortal wound to the entire enterprise. So he acted with conviction. Over the next few months, Buffett Partnership Limited invested 40% of its entire assets, a sum of $13 million, into American Express stock. It was a massive, concentrated bet, the kind of move that would be considered career suicide by any conventional wealth management professional. But it wasn't a gamble. It was an investment based on a profound informational advantage, an advantage gained not from speed or inside tips, but from the slow, deliberate work of independent thought and primary source analysis. The result? Within 2 years, the market came to its senses. The salad oil situation was resolved. The core businesses continued to print money, and the stock price more than tripled. Buffett's partnership made a profit of over $20 million. The American Express salad oil scandal became a cornerstone of the Buffett legend, a testament to the principle that in a world of noise, the quiet work of reading and thinking is the most powerful weapon an investor can possess. It is the ultimate proof that the path to beating the market lies not in following the headlines, but in diligently uncovering the facts that the headlines obscure. The psychological forces at play during the salad oil scandal are the very same ones that trap the average investor today. The core cognitive bias driving the panic was the narrative fallacy, a term coined by Nassim Nicholas Taleb. Our brains are wired to love simple, coherent stories. The story of American Express, trusted blue chip brought down by massive fraud, was simple, compelling, and easy to understand. It fit a clean narrative of downfall and disaster. This story was far more emotionally resonant than the complex, boring reality of balance sheets, business segments, and legal liabilities. When investors heard this story, their brains latched onto it. This was amplified by confirmation bias. Once an investor accepted the Amex is doomed narrative, they would subconsciously seek out and give more weight to information that confirmed it, every negative headline, every pessimistic analyst report, while dismissing evidence to the contrary. The market was essentially trapped in an echo chamber of its own creation, a feedback loop of fear based on a compelling but incomplete story. Buffett's approach was a direct antidote to these biases. By forcing himself to begin with the primary source, the annual report, he was refusing to engage with the market's narrative. The 10K is not a story. It is a collection of facts and figures. It is dry, complex, and emotionally neutral. Engaging with this document first forces the analytical part of your brain to take control before the emotional, story-loving part can be hijacked by a market panic. His on-the-ground research was a further buttress against the narrative. While the story was happening on Wall Street, the reality was happening in Omaha restaurants. By talking to real people using the product, he was gathering data points that directly contradicted the prevailing narrative. He was fact-checking the story and finding it to be false. Furthermore, the market was suffering from a severe case of availability heuristic. The most easily recalled information, the shocking, sensational news of the fraud, was given overwhelming importance in decision-making. The far more important but less available information about the durable profitability of the traveler's check business was ignored. Buffett's deep dive into the financial statements was a deliberate effort to counteract this. He was systematically searching for the less available but more critical data points. He was weighing the quantifiable earning power of the core business against the estimated but sensationalized liability of the warehousing division. This is a cerebral, analytical process that short-circuits the brain's lazy tendency to overweight what is recent and vivid. By committing to a process of fundamental analysis rooted in primary sources, you are building a psychological fortress against the biases that cause the 99% to buy high in a state of euphoria and sell low in a state of panic. You are choosing the world of probabilities and balance sheets over the world of stories and headlines. So how do we translate this into a practical, repeatable process? The first step is to adopt what can be called the business owner mindset filter. This is an applied mental model that you must run every potential investment through before you even look at a stock chart or read a news article. It's a blueprint for emulating Buffett's approach to the salad oil scandal. Step 1. Isolate yourself. For the first 48 hours of your research on a new company, you are forbidden from consuming any third-party opinions. No analyst reports, no news articles, no YouTube videos, no social media chatter. Your only sources of information are the company's own investor relations website. This act of creating an informational vacuum is critical. It prevents the market's narrative from coloring your initial analysis. Step 2. Download the source code. Go to the company's website and download the last 5 years of their 10K annual and 10Q quarterly reports. These are your foundational texts. This is your Bible for this specific investment. Everything you need to make an initial assessment is contained within these documents. Step 3. Ask the owner's question. Before you read a single word, you must ask yourself the fundamental question that separates an investor from a speculator. If I had enough money to buy this entire company, to own it outright and take it private, would I do it based on the information in these reports? This question completely reframes the task. You are no longer looking for a stock that will go up. You are looking for a wonderful business that you would be happy to own for a decade, regardless of what the stock market does tomorrow. This immediately forces you to think about long-term earning power, competitive advantages, and management quality, the very things Buffett focuses on. Step 4. Conduct your Omaha investigation. Just as Buffett walked the streets of Omaha, you must find a way to interact with the company's product or service. If it's a retailer like Costco, go to the store, observe the customers, talk to the employees. Is the store busy? Are the customers happy? If it's a software company like Adobe, Use their product. Read reviews on user forums. Understand the user experience. Does it solve a real problem? Is it beloved by its customers? This qualitative due diligence provides a real-world context for the numbers you are about to read. Step 5. Write your own story. After reviewing the primary documents and conducting your own on-the-ground research, and before consuming any outside opinions, write a one-page summary of the business. Describe what it does, who its customers are, and why it is or is not a good business. This act of articulating your own independent conclusion, based only on primary source analysis, is the final step in cementing your intellectual independence. Only after you have completed these 5 steps are you permitted to engage with the market's opinion. By then, you will have a fortified perspective, a shield of your own knowledge that will allow you to evaluate the noise, rather than be controlled by it. The antithesis to this disciplined approach is the path followed by the overwhelming majority of market participants, what we can call the path of the 99%. This is the path of the CNBC investor. Their research process begins not with a 10K, but with the television. They wake up and turn on the financial news, immediately immersing themselves in the day's dominant narrative. They are told that inflation is a worry, so they look for stocks that do well with inflation. They are told that a certain technology is the next big thing, so they chase after it. Their entire decision-making framework is reactive. They are not conducting investment analysis. They are reacting to stimuli. Let's take a hypothetical example. A company in the tech sector, let's call it Innovate Corp, misses its quarterly earnings estimate by a penny. The stock immediately drops 15% in pre-market trading. The CNBC investor wakes up to a red alert on their phone. They turn on the TV, and a panel of experts is discussing the news. The language is frantic and emotional. A shocking miss. Guidance disappoints. Investors are fleeing. The narrative is set. Innovate Corp is in trouble. The investor, gripped by fear and loss aversion, immediately sells their position, crystallizing a 15% loss. They did not read the quarterly report. They did not listen to the management conference call. They did not analyze whether the earnings miss was due to a one-time charge or a fundamental deterioration of the business. They simply reacted to a story packaged and delivered for maximum emotional impact. The tragedy is that this path feels productive. It feels like you are engaged and informed. You are watching the charts. You know the jargon. You are participating in the conversation. But in reality, you are a puppet. Your strings are being pulled by the news cycle and the market's mood swings. This investor outsources their most critical thinking to television personalities and anonymous Twitter accounts. They buy stocks based on a 2-minute segment between commercials and sell them based on a scary-looking headline. They suffer from what is known as headline risk, where their portfolio is constantly at the mercy of the next news story. They are perpetually buying at the peak of hype and selling at the trough of despair, because that is when the narratives are strongest. They completely misunderstand the nature of the game. They think investing is about knowing what will happen tomorrow. The Buffett-style investor knows that is impossible. They believe investing is about understanding the value of a business today so that you can ignore the noise about tomorrow. The 99% are playing a short-term game of prediction on an uneven playing field. The primary source investor is playing a long-term game of business analysis, a game they can actually win. The failure of the 99% is not a failure of intelligence. It is a failure of process and philosophy. They have chosen to drink from a fire hose of contaminated second-hand information, while the clean, pure spring of primary source data sits untouched, just a few clicks away. The direct financial connection between this philosophy and your bank account is the concept of alpha. In investment terminology, beta is the return you get from simply owning the market, like an S&P 500 index fund. Alpha is the excess return, the skill-based return that you generate above and beyond the market's performance. It is the mathematical proof of beating the market. Relying on news and market chatter guarantees you will, at best, achieve the market's return minus fees and taxes. This is because by the time information is a headline, it is already reflected in the stock price. There is no edge. There is no alpha. You are simply part of the herd, and the herd always gets average results. The entire purpose of the primary source philosophy is to systematically generate alpha by exploiting the information gap between the diligent DIY investor and the headline-reacting herd. When you do the work of reading the 10K, you are gaining an informational advantage. You might discover that the market is panicking about a temporary problem, like the salad oil scandal, creating a massive discrepancy between the stock's price and its true intrinsic value. The difference between the price you pay and the value you get is your margin of safety and the source of your future alpha. Over an investment lifetime, this process has a transformative financial impact. Consistently identifying even 2 or 3 of these mispriced opportunities per decade can be the difference between a standard retirement and true financial freedom. Let's quantify it. If the market returns an average of 8% per year and your portfolio also returns 8%, a $100,000 investment will grow to about $466,000 over 20 years. However, if your disciplined, primary source-based fundamental analysis allows you to generate just 4% of alpha, achieving a 12% annual return, that same $100,000 investment grows to approximately $964,000 over the same period. The difference is nearly $500,000. That is the tangible, life-changing financial power of this philosophy. It's not magic. It is the direct monetary reward for substituting the hard work of independent thought for the easy and ultimately unprofitable path of following the crowd. It is how genuine, lasting wealth building is achieved. Having established the foundational philosophy of prioritizing the primary source, we must now move from the why to the how. Pillar 2 is the tactical application of this philosophy, the art of reading an annual report from back to front. This may sound counterintuitive, even strange. We are taught from childhood to read things from beginning to end. But an annual report is not a novel. It is a strategic document, and the first few pages, the glossy photos, the slick graphics, the uplifting letter from the CEO, are often the least important. They are marketing. They are the company putting its best foot forward, painting the most optimistic picture possible, the real, unvarnished story of the business. The clues that our detective investor is searching for are almost always buried in the back, in the dense, text-heavy sections that most people skip. By starting at the back and moving forward, you are fundamentally re-engineering your own analytical process. You are forcing yourself to engage with the cold, hard, legally vetted facts before you are influenced by the company's narrative and marketing spin. You become an auditor before you become a fan. This back-to-front approach is a system designed to detect reality, to pierce the corporate veil, and to understand the business from the inside out, beginning with its most sensitive and revealing components. The story of Buffett's investment in See's Candies, made in 1972, is a masterclass in reading between the lines and understanding a business far beyond its surface-level financial statements. On paper, at first glance, See's Candies did not look like a typical Buffett investment. It was a family-owned California candy company. When Charlie Munger first brought it to Buffett's attention, the numbers were not spectacular. The company had tangible assets, things like factories, stores, inventory, of about $8 million. The See family was asking for a sale price of $30 million, which was later negotiated down to $25 million. This meant Buffett and Munger were being asked to pay a price more than 3 times the company's book value. For a traditional cigar butt value investor, as Buffett was known at the time, this was heresy. The old Buffett would have looked for companies trading for less than their liquidation value. But this investment marked a critical evolution in his thinking, an evolution driven by a deeper reading of the business's reality. Buffett and Munger did not just look at the balance sheet, they engaged in a deep dive, a forensic analysis of the company's character. They read the company's history, its financial reports, and they talked at length with the management. What they discovered was an asset that didn't appear anywhere on the balance sheet, a phenomenal economic moat built on brand loyalty and pricing power. See's Candies held a special place in the hearts of its customers. For decades, Californians had bought See's for holidays, for birthdays, for gifts. The act of giving a box of See's was associated with quality, affection, and tradition. This powerful brand association gave See's something magical: the ability to raise its prices every year without losing customers. A customer who needed a Valentine's Day gift was not going to risk disappointing their sweetheart by switching to a cheaper, unknown brand to save $1 or $2. They would happily pay the slightly higher price for the certainty of quality and the emotional resonance of the See's brand. This intangible asset, this economic goodwill, was the real value of the company. The factories and stores were worth $8 million, but the brand's power to command high prices and loyal customers was worth many times more. This is a classic example of what reading back to front helps you uncover. A simple skim of the financials would show a company with modest assets and decent, but not explosive, profits. The CEO's letter might talk about quality and tradition, but that's just marketing fluff. The real clues would be buried deeper. A forensic reader would look at the historical income statements, not just the most recent one. They would calculate the gross margins year after year. They would notice that even as the cost of sugar and labor went up, See's margins remained stable or even increased. This is a numerical clue that points directly to pricing power. They would look at the capital expenditures line on the cash flow statement and notice it was remarkably low. The company did not need to spend huge sums on research and development or fancy new factories to maintain its position. The moat was in the customer's mind, not in physical assets. This deeper understanding, gleaned from a careful reading of the company's long-term performance and character, is what allowed Buffett and Munger to pay $25 million for a company with only $8 million in tangible assets. They knew they were buying an economic machine that could produce ever-increasing amounts of cash with very little additional capital investment. And they were right. See's Candies went on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway over the decades, all while requiring very little new capital. It became Buffett's template for what he called the great business, one that earns high returns on capital and has a durable competitive advantage. The See's Candies story is the perfect testament to the back-to-front approach, because the most valuable asset of the company was invisible on the surface. It could only be detected by a financial detective looking for the subtle clues of pricing power and low capital intensity hidden within the historical financial statements, long before ever reading the CEO's optimistic narrative at the front of the report. The psychological principle that the back-to-front reading method masterfully exploits is our brain's vulnerability to the anchoring and priming effects. The anchoring effect is a cognitive bias where we rely too heavily on the first piece of information offered, the anchor, when making decisions. In an annual report, the first things you see are the glossy photos and the CEO's letter. This letter is professionally crafted by investor relations teams to be optimistic and reassuring. It frames the company's performance in the best possible light. If you read this first, your brain anchors on this positive narrative. As you proceed to the financial statements, you will subconsciously interpret the numbers through this positive lens, a form of confirmation bias. You'll be more likely to explain away a negative data point as a one-off or temporary, because you've been primed to think positively about the company. Priming is the related idea that exposure to one stimulus influences your response to a subsequent stimulus. The happy pictures of smiling employees and the CEO's talk of record growth and exciting futures primes your brain for acceptance, not skepticism. By starting at the back of the 10K with the footnotes to the financial statements, you completely invert this psychological dynamic. The footnotes are the opposite of a marketing document. They are dense, legalistic, and written by lawyers and accountants to comply with regulations. They contain the critical details about accounting methods, debt obligations, lawsuits, and pension liabilities. There is no positive spin here. By starting with this complex, neutral to negative information, you anchor your analysis in reality and skepticism. You are priming your brain to be a critic, a forensic accountant. When you eventually get to the CEO's letter at the end of your process, you will read it with a completely different perspective. You will compare the CEO's optimistic claims against the hard facts you've already uncovered in the footnotes and financial statements. You might read the CEO boasting about record revenues, but you will know from your prior reading that those revenues were achieved through an aggressive accounting change or by extending risky credit to customers, facts you discovered in the footnotes. The back-to-front method transforms the CEO's letter from a seductive narrative into a test of management's credibility. It becomes a cross-examination. Does the story they tell match the facts you've already found? This process protects you from the powerful 1-2 punch of anchoring and priming that corporate communications are designed to deploy. It is a systematic way to force your own intellectual rigor and ensure that your investment analysis is built on a foundation of fact, not marketing. To put this into practice, we can develop a specific mental model, the forensic accountant sequence. This is a step-by-step blueprint for how a DIY investor can dissect an annual report like a professional. Step 1. Go directly to the Notes to Consolidated Financial Statements. Do not pass go. Do not collect $200. This is your starting point. You will not understand everything here, and that's okay. Your goal is to get a feel for the company's complexity and to hunt for specific items. Look for the note on significant accounting policies. Does the company use aggressive or conservative methods for recognizing revenue or depreciating assets? Look for the note on commitments and contingencies. Are there any major lawsuits or environmental liabilities looming? Look for the note on debt. What are the terms of their loans? Are there restrictive covenants that could get them in trouble? Spending the first hour in the footnotes is like a doctor reading a patient's chart before talking to them. It gives you the unvarnished facts. Step 2. Read the Management's Discussion and Analysis of Financial Condition and Results of Operations, MD&A. This is arguably the most valuable section of the entire report. Here, management is required to explain, in plain English, the numbers from the financial statements. They have to discuss the trends in their business, what went well, what went poorly, and what risks they see on the horizon. Read this section like a detective. If sales are up, did they say it was because they sold more units? Good. Or because they raised prices? Also good. Or because of a one-time acquisition needs more investigation? If costs are up, are they blaming temporary factors? Or is there a permanent erosion in their profitability? Look for what they don't say as much as what they do. Are they glossing over a struggling division? Are their explanations clear and candid? Or are they filled with confusing jargon? Step 3. Analyze the 3 core financial statements. Now that you have context from the footnotes and MD&A, you can look at the numbers. Start with the cash flow statement. Is the company actually generating cash? Or are its profits just an accounting fiction? Look at the balance sheet. Is the debt level manageable? Is goodwill from past acquisitions growing, suggesting they might be overpaying for growth? Finally, look at the income statement. Are the revenues and profits growing consistently over time? How do the margins compare to competitors? Step 4. Only now, at the very end of the process, do you read the letter to shareholders from the CEO. Having done all the forensic work, you are now immune to its marketing charm. You can read it as a final test. Does the CEO's message align with the financial reality you have uncovered? Do they address the problems you identified in the MD&A head-on, or do they ignore them? Are they candid about their mistakes, or do they only talk about their successes? By the time you finish the CEO's letter, you will have a multidimensional, deeply informed view of the company. You will have built your own opinion from the ground up, based on facts, before ever being exposed to the corporate narrative. This sequence is a rigorous portfolio strategy that forces due diligence and protects you from being seduced by a good story. The antithesis of this disciplined sequence is the path of the skimmer. This represents the 99% of investors who do bother to look at an annual report at all, but do so in a way that is superficial and ultimately misleading. The skimmer downloads the annual report, impressed by their own diligence. They open the PDF and are greeted by beautiful, full-color photographs of the company's products and happy, diverse employees. They see a professionally designed layout with bold headlines and inspiring quotes. They navigate to the letter from the CEO. They read the first paragraph, which talks about a challenging but successful year, and thanks the dedicated team. They skim through the rest of the letter, their eyes catching on phrases like strategic investments, innovation pipeline, and poised for future growth. Then, they jump to the financial highlights page, a one-page summary that shows revenues and profits in a nice, upward-sloping bar chart. They see that revenue went up 10% this year. Great, they think. The company is growing. They feel satisfied. They've done their research. They close the document and buy the stock. This process is worse than doing no research at all because it creates an illusion of knowledge. The skimmer has not performed investment analysis. They have consumed a marketing brochure. They missed the footnote that explained that the 10% revenue growth was entirely due to an acquisition of a low-margin business, and that the core legacy business actually shrank by 5%. They missed the section in the MD&A where management warned that their largest customer, representing 30% of sales, has not yet renewed their contract for the upcoming year. They missed the note on the cash flow statement, showing that while reported profits were up, actual cash from operations was down significantly because their inventory is piling up unsold. They missed the footnote, disclosing a new, potentially devastating lawsuit from a competitor. The skimmer sees the pretty picture on the front of the box, but the forensic accountant has opened the box and discovered that some of the parts are missing and the instructions are on fire. The skimmer buys the story, and when the inevitable bad news about the customer contract or the lawsuit finally becomes a headline, they are shocked and wonder what went wrong. What went wrong was their process. They mistook the sizzle for the steak, and in the world of investing, that is a recipe for financial disaster. The direct financial connection of the back-to-front method is the cultivation of a robust margin of safety, the most important concept in value investing. Coined by Benjamin Graham, Buffett's mentor, the margin of safety is the difference between the intrinsic value of a business and the price you pay for it in the market. A large margin of safety is what protects you from bad luck, unforeseen problems, or errors in your own judgment. It is the buffer that makes investing a winning proposition over the long term. A superficial front-to-back reading of an annual report will almost always lead you to overestimate a company's intrinsic value. You are seduced by the narrative and miss the hidden risks. You might calculate a value of $100 per share and buy the stock at $80, thinking you have a 20% margin of safety. But the forensic accountant, by starting with the footnotes, might uncover off-balance sheet liabilities or other problems that lead them to calculate the true intrinsic value at only $70 per share. From their perspective, buying at $80 isn't a bargain. It's a risky speculation with a negative margin of safety. The true financial benefit of this rigorous process is risk mitigation. It helps you avoid the permanent loss of capital that comes from overpaying for a business whose problems are hidden just beneath the surface. Let's quantify this. Imagine two investors. Investor A is a skimmer. He buys 10 stocks over a decade. 9 of them do okay, but one of them, a company whose hidden problems he missed, goes to zero. That single catastrophic loss can wipe out a huge portion of his gains from the other 9. Investor B is a forensic accountant. Her rigorous back-to-front process might cause her to pass on more companies, but it helps her avoid that one big loser. Her overall returns will almost certainly be higher, not because she picked more winners, but because she successfully dodged the one catastrophic landmine. The financial power of this method is defensive. It's about avoiding the strikeouts. In the long game of wealth building, avoiding the big mistakes is far more important than hitting the occasional home run. The back-to-front method is your financial seatbelt and airbag. It might not make the ride faster, but it dramatically increases the odds that you'll arrive at your destination safely. Once we have committed to analyzing primary sources and learned the tactical approach of reading them back to front, we arrive at Pillar 3, the central purpose of our detective work. We are not just reading for the sake of reading. We are on a specific mission. We are searching for the economic moat. This is a term popularized by Buffett to describe a durable competitive advantage that protects a business from competitors, much like a real moat protects a castle from invaders. The wider the moat, the more sustainable the business's profits will be over the long term. This is the secret ingredient to long-term compounding. A company without a moat might have a good year or two, but eventually, its high profits will attract competition, and those profits will be competed away. A company with a deep, wide moat can earn high rates of return on its capital for decades, fighting off competitors and creating enormous value for its long-term owners. Reading an annual report through the lens of a moat detective transforms the document from a simple accounting report into a strategic analysis. You are no longer just asking, did the company have a good year? You are asking the far more important question. Why did the company have a good year, and is that reason sustainable for the next 20 years? Your stock research becomes a quest to identify the structural characteristics of a business that give it this lasting power. The quintessential story of Buffett's search for an economic moat is his monumental investment in the Coca-Cola Company in 1988. This was not a small bet. After the stock market crash of 1987, Buffett invested over $1 billion, representing more than a quarter of Berkshire Hathaway's entire portfolio at the time, into Coca-Cola stock. This decision was the culmination of decades of observation and a deep understanding of the company's unassailable competitive advantage, an understanding he gleaned from a careful reading of its history and its financial reports. The context is fascinating. Buffett had been a fan of the product his entire life, famously drinking at least 5 Cokes a day. But for years he had resisted investing, believing the business was too capital-intensive and not growing fast enough. What changed his mind was a combination of the 1987 market crash, which made the price attractive, and a deeper analysis of the company's global business model, which revealed a moat of breathtaking width and permanence. When Buffett read through decades of Coca-Cola's annual reports, he wasn't just looking at the recent numbers, he was looking for a pattern, a story of enduring dominance. He saw a business that was remarkably simple and unchanging. The core product had been the same for 100 years. This meant the company didn't have to spend billions on research and development to stay relevant, unlike a technology or pharmaceutical company. The R&D line on the income statement was minuscule compared to its massive revenues. This was a clue. The real genius, which he saw reflected in the financials, was the business model. Coca-Cola itself didn't handle the costly, low-margin business of bottling and distribution. It sold a highly profitable syrup concentrate to a global network of independent bottlers. This meant that Coca-Cola was an incredibly, quote, capital-light business. A look at its balance sheet and cash flow statement would reveal an astonishingly high return on tangible assets. It required very little incremental capital to grow its sales. As a bottler in Manila sold one more Coke, a tiny bit of syrup was used, and a royalty check flowed back to headquarters in Atlanta. It was a machine for printing money. But the true moat, the one that made the business nearly invincible, was not in the financials at all, though its effects were everywhere. It was the brand. The Coca-Cola brand was, and is, one of the most powerful assets on planet Earth. It resides in the mind of billions of consumers. In his letters, Buffett would later write about the share of mind that Coke commanded. When someone in a remote village, anywhere in the world, felt thirsty, the word Coke would often be the first thing to pop into their head. This mental dominance, built over a century of advertising and consistent presence, created a moat that was almost impossible for a competitor to breach. A new soda company could build a factory and hire delivery trucks, but it could not replicate the brand that was woven into the fabric of global culture. This brand power gave Coca-Cola immense pricing power. It could raise the price of its syrup by a fraction of a cent each year, a move that was barely noticed by the end consumer, but which translated into hundreds of millions of dollars in additional, pure profit. Reading the annual reports, Buffett would have seen this in the form of steadily expanding gross margins over decades. He saw a castle, the Coca-Cola Company, protected by the deepest moat imaginable, a simple, capital-light business model combined with the most dominant consumer brand in human history. The billion-dollar investment was not a bet on the next quarter's earnings. It was the purchase of a piece of a permanent economic franchise, identified through a long-term study of its primary source documents. It was the ultimate prize for a moat detective. The psychological principle that trips up most investors and prevents them from finding these moated businesses is herd behavior, driven by the powerful force of social proof. Humans are social creatures. We have a deep-seated instinct to follow the crowd. In prehistoric times, if everyone in your tribe suddenly started running, it was a good idea to start running too, rather than stopping to figure out if that was really a saber-toothed tiger. This instinct is still wired into our brains. In the world of investing, this manifests as a powerful urge to buy what is popular and sell what is unpopular. We see a stock or a sector, like tech or cryptocurrency, getting a lot of attention and going up in price. We see our friends and neighbors getting rich. This provides social proof that it's the right thing to do, so we pile in, often near the top. This herd behavior is the enemy of moat-based investing. Moats are often found in boring businesses. Companies like Coca-Cola, See's Candies, or Waste Management don't generate exciting headlines. The herd is busy chasing the next revolutionary technology or story stock. This is a huge advantage for the independent thinker. Buffett's entire process is designed to be a solitary one. The act of sitting alone and reading a dense 10K is a powerful antidote to herd behavior. It physically and mentally separates you from the madness of the crowd. You are not listening to the chatter. You are focused on the facts. The search for a moat forces you to adopt a different, contrarian mindset. You are not looking for what is hot. You are looking for what is durable. You are asking questions that the herd never considers. The herd asks, how fast can this company grow its revenue? The moat investor asks, how likely is this company to be around and more profitable in 20 years? The herd is focused on the story. The moat investor is focused on the business structure. By committing to this analytical framework, you are giving yourself psychological permission to ignore the crowd. Your validation comes not from seeing others buy the same stock, but from your own due diligence and conviction in the company's competitive advantage. It is a system that replaces the need for social proof with the confidence of intellectual proof. This allows you to patiently hold or buy a great boring business like Coca-Cola, even while the rest of the world is chasing speculative bubbles, which is precisely how long-term outperformance is generated. To make this practical, we need an applied mental model for our stock research, the Moat Detection Checklist. This is a series of specific questions you should ask yourself while reading an annual report, with pointers to where you might find the answers. This checklist turns your reading from a passive activity into an active investigation. Question 1. Does this company have pricing power? This is the single most important sign of a moat. The ability to raise prices without losing significant business to competitors is the hallmark of a great company. Where to look? The MD&A. Management might discuss their pricing strategy. More importantly, look at the 10-year financial summary. Calculate the gross profit margin over time. If the margin is high and stable, or even increasing, it's a strong sign of pricing power. Question 2. Does this business benefit from a network effect? A network effect exists when a product or service becomes more valuable as more people use it. Think of Visa or MasterCard. The more merchants that accept it, the more valuable it is to cardholders, and vice versa. Where to look? The business description section at the beginning of the 10K. Analyze how the business works. Does it connect different groups of users? Look at metrics like user growth and engagement if the company provides them. A strong network effect is a powerful moat. Question 3. Is this a low-cost producer? Can this company provide its product or service cheaper than its rivals, due to scale or a unique process? Think of Walmart or Geico. Where to look? Compare the company's operating margins and SG&A, selling, general, and administrative expenses as a percentage of sales to its closest competitors. A consistently lower cost structure is a clear competitive advantage. Question 4. Does this business have a strong brand or other intangible assets? Like Coca-Cola or See's Candies, does the company's name alone command loyalty and pricing power? Does it have patents or regulatory licenses that block competition? Where to look? The balance sheet. To see how much is allocated to, quote, goodwill and intangible assets. But more importantly, look at marketing spend in the income statement versus revenue growth. A great brand can grow without a proportional increase in marketing spend. Question 5. How high are the customer switching costs? Is it difficult, expensive, or risky for a customer to switch from this company's product to a competitor's? Think of the software that runs a bank's core operations. Switching would be a nightmare. Where to look? The MD&A might discuss customer retention or churn rates. Look for businesses that embed themselves into a customer's workflow. Long-term contracts and high retention rates are a great sign. By systematically running a company through this 5-question checklist, using the annual report as your source document, you can move beyond simple financial analysis and begin to truly understand the quality and durability of the business itself. This is the core of value investing. The antithesis of this disciplined search for durability is the path of the growth chaser. This investor is addicted to the thrill of a good story and the allure of explosive revenue growth. They are not interested in boring, predictable businesses with moats. They are looking for the next Amazon, the next Tesla, the company that is going to change the world. Their stock research consists of finding companies in the hottest sectors: artificial intelligence, electric vehicles, biotech, and identifying the ones with the fastest growing sales figures. They see a company whose revenue grew 100% last year and immediately get excited, rarely stopping to ask the critical follow-up questions. They don't check if the company is profitable. In fact, they often see massive losses as a good thing, a sign that the company is reinvesting for growth. They don't analyze the competitive landscape. They assume that because the company is growing fast now, it will continue to do so forever. Let's consider the dot-com bubble of the late 1990s as the ultimate example of this folly. Investors were obsessed with eyeballs and page views. They poured billions of dollars into companies like Pets.com or Webvan. These companies had incredible revenue growth, but they had no moat and no path to profitability. Pets.com was selling pet supplies online for less than they paid for them, hoping to acquire customers. They had no pricing power, no brand loyalty that couldn't be replicated, and no low-cost advantage. They were just a story. The growth chaser bought into the story. They saw the revenue growth and extrapolated it into the future, ignoring the complete lack of a sustainable business model. When the bubble burst, these companies went to zero, and the portfolios of the growth chasers were annihilated. The mistake of the growth chasers is to confuse a company's temporary success with a durable competitive advantage. They are buying a lottery ticket, not a business. The moat detective, in contrast, would have looked at a company like Pets.com and, using the checklist, would have immediately seen the flaws. No pricing power, no intangible assets, low switching costs. They would have passed, and in doing so, preserved their capital. The growth chaser is playing a game of musical chairs, hoping to get out before the music stops. The moat detective refuses to play at all, preferring to own the company that manufactures the chairs. The direct financial connection between finding a moat and your long-term wealth is the powerful engine of compounding. Specifically, it is a company's ability to generate a high return on invested capital, ROIC. ROIC is a measure of how effectively a company is using the money invested in its operations to generate profits. A company with a wide economic moat is, by definition, a company that can consistently generate a high ROIC. Its competitive advantage protects it from the forces that would normally drive down returns. This is the mathematical key to wealth building. Imagine a company that can consistently reinvest its earnings at a 20% rate of return. A dollar of earnings that is retained and reinvested in the business becomes $1.20 of earning power the next year, which then becomes $1.44 the year after, and so on. This is the magic of compounding at the corporate level. The stock price of such a company will, over the long term, inevitably follow this upward march of intrinsic value. When you read an annual report, you can calculate the ROIC yourself. You can find the inputs, net operating profit after tax, and invested capital in the financial statements. When you find a business that has maintained a high ROIC, say over 15%, for 5 or 10 years, you have likely found a business with a moat. This is a quantitative signal that backs up the qualitative analysis from your checklist. The financial benefit is twofold. First, the business itself is growing its intrinsic value at a rapid rate. Second, a moated business is often a safer investment. Its durable advantages make its earnings more predictable and less susceptible to economic downturns or competitive pressures. This combination of high return and lower risk is the holy grail of investing. By focusing your stock research on identifying these economic moats, you are directly targeting these specific corporate characteristics that are mathematically proven to drive superior long-term financial returns and create life-changing wealth for shareholders. We have now established our philosophy, our tactical approach, and our primary objective. The fourth pillar addresses a more subtle but equally critical aspect of our detective work, identifying managerial candor and competence. Warren Buffett has famously said that he tries to buy businesses that are so wonderful that an idiot could run them, because sooner or later, one will. While he looks for great businesses, he also understands that the people at the helm are immensely important. The managers of a company are the stewards of the owner's capital. Their decisions about how to allocate that capital, whether to reinvest it in the business, buy other companies, pay dividends, or buy back stock, will have a colossal impact on long-term shareholder returns. Therefore, a key part of reading an annual report is to read the people behind the numbers. You are not just analyzing a business, you are choosing a business partner. You are looking for signs of integrity, intelligence, and a rational shareholder-oriented mindset. This is a qualitative art, but the annual report, particularly the CEO's letter, provides a rich trove of clues for the discerning investor. One of the most powerful stories illustrating Buffett's focus on backing the right manager is his 1983 acquisition of Nebraska Furniture Mart from the legendary Rose Blumkin, better known as Mrs. B. This was not an investment in a slick modern corporation. It was a bet on a 90-year-old Russian immigrant who had built a retail empire in Omaha from scratch. Mrs. B arrived in America in 1917, unable to speak English. She started her business in 1937 with a $500 loan from her brother, selling used furniture out of the basement of her husband's pawn shop. Her business philosophy was brutally simple and effective: sell cheap and tell the truth. She was an obsessive, workaholic business genius, known for her incredible negotiating skills with suppliers and her relentless focus on giving customers the lowest possible price. By the 1980s, Nebraska Furniture Mart was the single largest home furnishing store in the United States, doing hundreds of millions of dollars in sales out of one location, with profit margins that were the envy of the entire industry. Buffett had observed Mrs. B and her business for decades. He was a loyal customer himself. He saw a business with a powerful, albeit localized, economic moat built on a low-cost operational model and a fanatical customer base. But the true asset, the one he was most interested in, was Mrs. B herself and the culture she had built. In 1983, Buffett approached her about buying the company. The negotiation was famously simple. Buffett asked her for a price. She named a number, around $60 million. Buffett said yes, without even looking at the company's audited financials. He sealed the deal with a simple, two-page contract and a handshake. He didn't need to perform complex due diligence on the numbers, because he had performed decades of due diligence on the character of the manager. He knew Mrs. B was honest to the core. He knew she understood her business better than anyone on earth. He knew she treated the company's money as if it were her own, because it was. He was not buying a collection of assets. He was buying a culture of relentless efficiency and customer focus, embodied by its founder. How does this connect to reading reports? For a private company like Nebraska Furniture Mart, there were no public annual reports. But Buffett's analysis of Mrs. B is a perfect model for how he reads the letters of public company CEOs. He is looking for the same traits. He wants to see a CEO who writes and talks like a business owner, not like a corporate bureaucrat. He looks for candor. Does the CEO openly admit to mistakes they made during the year? A manager who blames bad results on external factors like the economy or the weather is waving a red flag. A manager who says, "I made a mistake in this acquisition, and here's what I learned," is demonstrating the kind of integrity and rationality Buffett seeks. He looks for a rational approach to capital allocation. Does the CEO's letter clearly explain how they plan to use the company's excess cash? Do they discuss share buybacks in terms of price versus value? Or do they just buy back stock at any price to prop up earnings per share? Mrs. B's capital allocation strategy was simple: keep prices brutally low to build market share and customer loyalty. Everything was reinvested to strengthen that moat. Buffett looks for that same long-term owner-like thinking in the CEOs of public companies. The story of Mrs. B is a reminder that behind every financial statement are human beings making decisions. Your job as a financial detective is to read through the numbers to assess the character and competence of those people. You are looking for a Mrs. B, not a slick promoter. And the CEO's letter is your primary piece of evidence. The psychological principle at the heart of this pillar is the need to overcome authority bias and the halo effect. Authority bias is our tendency to attribute greater accuracy and importance to the opinion of an authority figure. CEOs are authority figures. They are often charismatic, confident, and lauded in the business press. It is very easy to listen to a CEO on a conference call or read their letter and simply accept what they say at face value. We assume they are brilliant and that their strategy is the right one, because they are the ones in charge. The halo effect is a related bias, where our overall positive impression of a person or company influences our evaluation of their specific traits. If a company's stock has been going up and the CEO is praised by the media, we are likely to view all of their decisions through a positive halo, assuming their capital allocation is brilliant and their strategy is flawless, even if the evidence in the financial statements suggests otherwise. Buffett's method of analyzing management is a systematic process for shattering the halo and questioning authority. He does not take a CEO's words at face value. He performs a say-do analysis. He reads what the CEO said they were going to do in last year's annual report, and then he looks at the numbers in the current year's report to see what they actually did. Did the CEO promise synergies from a big acquisition? Buffett will look at the margins of the combined company a year later to see if those synergies actually materialized. Did the CEO promise to be disciplined about share buybacks? Buffett will check the financial statements to see at what price the company bought back its stock. If they bought it back when the stock was at an all-time high, their claims of discipline are proven false. This approach is a powerful antidote to authority bias because it puts the burden of proof on the manager. Their words are not evidence. They are a hypothesis to be tested against the data. This rigorous cross-referencing of words and actions allows the informed investor to make a judgment based on performance, not on personality or reputation. It's a way to ensure you are investing in a competent capital allocator, not just a charismatic storyteller. You are using the annual report as a lie detector, comparing the promises made in one chapter, the CEO letter, with the results reported in another, the financial statements. To operationalize this, we can use an applied mental model called the Capital Allocator Scorecard. This is a framework for grading a company's management team based on the evidence found within the annual report. You would create a simple scorecard for each company you analyze, giving the management a grade from A to F on several key criteria. Criterion 1. Use of free cash flow. How does the company use the cash it generates after funding its operations? Look in the cash flow statement under cash flow from financing activities and cash flow from investing activities. Are they paying a sensible dividend? Are they buying back shares at intelligent prices? Are they making acquisitions? Grade them on the intelligence of these choices. A company that takes on massive debt to buy back its stock at the top of the market gets an F. A company that patiently waits for a downturn to repurchase shares at a discount gets an A. Criterion 2. Attitude towards debt. Look at the balance sheet. How has the company's debt level changed over the past 5 years? Read the MD&A to understand why they are borrowing money. Is it for productive investments that will generate high returns? Or is it to fund vanity projects or cover up operational shortfalls? A management team that is conservative with debt and uses it strategically earns a high grade. Criterion 3. Candor and transparency. Read the last 3 CEO letters. Does management speak in plain, simple language, or do they use confusing corporate jargon? Do they openly discuss their mistakes and what they learned from them? Do they provide clear metrics to judge their own performance? The more candid and transparent, the higher the grade. A letter full of buzzwords and excuses gets a low grade. Criterion 4, executive compensation. This is a critical one. Look in the proxy statement, which is filed separately from the 10K. This document details how much the top executives are paid. Is their compensation tied to metrics that actually create long-term shareholder value, like return on invested capital or free cash flow per share? Or is it tied to short-term metrics like quarterly earnings per share or simply the stock price, which can encourage value-destroying behavior? A well-designed, shareholder-aligned compensation plan gets an A+. A plan that lavishly rewards executives for mediocre performance gets a failing grade. By using this scorecard, you create a systematic, evidence-based process for evaluating management. It forces you to move beyond your gut feelings about a CEO and make a cold, hard judgment about their skills as a capital allocator. This is a crucial step in advanced fundamental analysis. The antithesis of this rigorous evaluation is the path of the cult of personality follower. This investor doesn't invest in businesses. They invest in celebrity CEOs. They are drawn to the visionary, the disruptor, the charismatic leader who graces the covers of magazines and gives inspiring keynote speeches. They buy the stock of a company like Tesla, not because they have done a deep dive on its production capacity, profit margins, or competitive position in the global auto market, but because they believe in the genius of Elon Musk. They outsource their entire due diligence process to one person. They assume that because the CEO is brilliant in one area, like engineering or marketing, they must be brilliant in all areas, including capital allocation and financial management. This is the halo effect in its most extreme form. The follower will read the company's annual report, if they read it at all, not with a critical eye, but with the adoring gaze of a fan. Every bold proclamation from the CEO is taken as gospel. Any troubling numbers in the financial statements, massive cash burn, soaring debt, questionable accounting, are dismissed as the short-term costs of genius and long-term vision. The danger of this approach is that it is a complete abdication of investment responsibility. The follower has tied their financial fate to the whims, ego, and fallibility of a single human being. When the celebrity CEO makes a brilliant move, the follower feels like a genius. But when that same CEO makes a disastrous acquisition, takes on too much debt, or gets distracted by a new side project, the follower's portfolio suffers the consequences. They have no independent conviction to fall back on, because their conviction was never in the business itself. It was in the person. The capital allocator's scorecard is anathema to this type of investor. It would force them to confront uncomfortable truths. It would force them to grade their hero on their actual performance, not on their reputation. This is why the 99% often gravitate towards the cult of personality approach. It's easier. It requires no difficult analytical work. It feels exciting to be part of a movement led by a visionary. But it is not investing. It is a form of hero worship, and hero worship is a notoriously poor portfolio strategy. The direct financial connection of backing good management is the concept of shareholder yield. Total return from an investment comes from 3 sources: price appreciation, dividends, and the effect of share buybacks. The latter 2 components, which are a direct result of capital allocation decisions made by management, are often referred to as shareholder yield. A management team that is skilled at capital allocation can dramatically increase your total return over time. Let's quantify this. Imagine Company A and Company B are identical businesses, each generating $100 million in free cash flow per year. The management of Company A decides to reinvest all of that cash flow into mediocre projects that only earn a 5% return. The management of Company B, however, is more disciplined. They reinvest half the cash flow into high-return projects that earn 20%, and they use the other half to buy back their own undervalued shares, reducing the share count and increasing each remaining shareholder's ownership stake in the business. Over a decade, the intrinsic value per share of Company B will have grown dramatically faster than that of Company A, and its stock price will have almost certainly followed suit. The difference in shareholder wealth creation is enormous, and it is entirely due to the different capital allocation skills of the management teams. By using the capital allocator scorecard to identify management teams like the one at Company B, you are directly tilting the odds of superior financial returns in your favor. You are investing in businesses that are not only operationally sound but are also being run by people who are actively and intelligently working to increase the long-term value of your shares. This focus on management quality is a powerful and often overlooked driver of beating the market. We have arrived at the fifth and final pillar. This is the defensive side of our framework. After learning to focus on primary sources, read them tactically, search for economic moats, and judge management, we must now learn how to use these same skills to avoid disaster. Pillar 5 is the art of uncovering hidden risks and red flags. Every investor is focused on finding the next big winner, but the true secret to long-term wealth building is avoiding the big losers. A single catastrophic loss, a stock that goes down 80% or 90%, can do so much damage to your portfolio that it can take years or even decades to recover. It is the mathematical enemy of compounding. Therefore, the most important job of the financial detective is not just to find reasons to buy a company, but to actively search for reasons not to buy it. This requires a shift in mindset, from one of an optimist looking for a great story to one of a skeptic looking for flaws in the evidence. The annual report is your primary tool for this pre-mortem analysis, a document filled with clues to potential trouble if you know where and how to look. There is no more painful or instructive story about overlooking risks than Buffett's own massive mistake, the acquisition of Dexter Shoe Company in 1993. Buffett has repeatedly called this his worst deal ever, and for a very specific reason. He didn't just overpay for Dexter, he paid for it using Berkshire Hathaway's own stock. At the time, he exchanged $433 million worth of Berkshire stock for the company. That same stock today would be worth billions and billions of dollars, making it a multi-billion-dollar error. It's a mistake that haunts him, and it serves as the ultimate cautionary tale for all investors. Dexter Shoe was, for many years, a wonderful American business. Based in Maine, it manufactured rugged, high-quality, affordable shoes. It had a strong brand, a great reputation, and a long history of profitability. On the surface, it looked like a classic Buffett business with a durable competitive advantage. Buffett himself wrote in his 1993 letter, "Dexter, I can assure you, is a business that possesses enduring competitive advantages." He believed its moat was secure. The problem, which became devastatingly clear in the years that followed, was that Dexter's economic moat was built on a foundation of sand. Its competitive advantage was rooted in its American-based manufacturing and its strong domestic brand. But that advantage was about to be washed away by a tidal wave of globalization and low-cost foreign competition. Cheaper labor in countries overseas allowed competitors to produce shoes of similar quality for a fraction of the cost. Slowly at first, and then with brutal speed, Dexter's moat evaporated. Its pricing power disappeared, its margins collapsed. The business that Buffett thought was permanent and durable was, in fact, incredibly vulnerable to a structural shift in the global economy. Within a decade of Berkshire's purchase, the business was essentially worthless. Where were the red flags? With the benefit of hindsight, a skeptical detective reading the annual reports of Dexter, had they been public, and its competitors in the early 1990s, might have picked up some clues. They might have noticed the trend of other American shoe manufacturers moving their production offshore. They might have seen the gross margins of companies that were importing shoes from Asia steadily increasing, while the margins of domestic producers were beginning to stagnate. In the MD&A section of a competitor's report, there might have been discussions of sourcing strategies and global supply chains that would have hinted at the massive competitive threat. A deep analysis of the industry's fundamentals, not just the single company's historical performance, might have revealed the erosion of the entire domestic manufacturing moat. Buffett himself admitted his mistake was not in misjudging Dexter's past, but in misjudging its future. He failed to properly analyze the biggest risk to the business. The Dexter shoe story is a brutal lesson in the importance of Pillar 5. It shows that even the greatest investor in the world can make a catastrophic error if they fall in love with a company's history and fail to rigorously search for the hidden risks that could destroy its future. It underscores the need to actively look for disconfirming evidence to ask what could go wrong, with the same rigor that we ask what could go right. The psychological bias that makes this so difficult is our old enemy, confirmation bias, supercharged by two other powerful forces, loss aversion and the sunk cost fallacy. As we've discussed, confirmation bias is our natural tendency to seek out and favor information that confirms our existing beliefs. When we get excited about a potential investment, we start to build a positive story in our minds. We then subconsciously look for evidence in the annual report that supports our story. Growing revenues, a respected brand, a confident CEO letter. We naturally tend to skim over or dismiss information that contradicts our narrative, like rising inventory levels or declining cash flow. This is compounded by loss aversion, the principle that the pain of losing is psychologically about twice as powerful as the pleasure of gaining. This makes it very difficult for us to accept that we might be wrong about an investment, because being wrong means facing a potential loss. So we ignore the red flags to avoid that psychological pain. If we already own the stock, the sunk cost fallacy kicks in. We have already invested time, emotional energy, and money into the stock, so we feel a powerful urge to stick with it, even in the face of mounting negative evidence. We think, I can't sell now, I have to wait until I get back to even. This combination of biases creates a powerful psychological vortex that pulls us towards optimism and away from the skeptical, defensive mindset required to spot hidden risks. A formal process of searching for red flags is a necessary corrective. It is a system designed to force our brains to do what they are naturally reluctant to do. Actively try to prove our own initial thesis wrong. To counter these biases, we need a specific, non-negotiable step in our investment analysis, the pre-mortem analysis. This powerful mental model, championed by psychologist Gary Klein, involves imagining that you have already made the investment and that, 1 year later, it has been an absolute disaster. The stock is down 80%. Now your job is to write the story of what happened, what went wrong, what red flags in hindsight did you miss. By forcing yourself to perform this exercise before you invest, you give yourself permission to think negatively and critically without the emotional pain of an actual loss. It flips the script on confirmation bias. Your goal is no longer to find reasons why the investment will succeed, but to find the most plausible reasons for its failure. You use the annual report as your source document for this pessimistic story. Here is a checklist of specific red flags to hunt for during your pre-mortem analysis. Red flag 1. Revenue recognition shenanigans. Go to the significant accounting policies footnote. Read how the company recognizes revenue. Is it straightforward, or is it complex and confusing? Aggressive revenue recognition is one of the oldest accounting tricks in the book. Red flag 2. Divergence between profits and cash flow. Look at the income statement and the cash flow statement. If net income is going up year after year but cash from operations is flat or declining, this is a massive red flag. It suggests the reported profits are not real. Red flag 3. Soaring inventory or accounts receivable. On the balance sheet, compare the growth rate of inventory and accounts receivable to the growth rate of sales. If inventory is growing much faster than sales, it means the company's products aren't selling. If receivables are growing much faster, it means they are selling to customers who aren't paying their bills. Red flag 4. Increasing debt and deteriorating margins. This is a potentially lethal combination. If a company is borrowing more money, seen on the balance sheet and cash flow statement, at the same time its profitability, gross and operating margins on the income statement, is shrinking, it can be a sign of a business in a death spiral. Red flag 5. Over-reliance on a single customer. In the risks section of the 10K, the company must disclose if a single customer accounts for more than 10% of its revenue. This is a significant vulnerability. The loss of that one customer could cripple the business. By systematically hunting for these and other red flags, you build the defensive part of your portfolio strategy, forcing yourself to see the bear case as clearly as the bull case. The antithesis to this skeptical diligence is the path of the hopeful optimist. This investor is a classic case of falling in love with a stock. They find a company they admire, perhaps because they love its products or believe in its mission. They construct a beautiful story about its future potential. From that point on, their research process becomes an exercise in reinforcing that initial belief. They are not conducting due diligence, they are seeking affirmation. When they read the annual report, they wear rose-colored glasses. They see the 20% revenue growth, but explain away the fact that the company is burning through cash at an alarming rate as a necessary, quote, investment in the future. They see the mounting pile of inventory on the balance sheet, not as a sign of weak demand, but as the company, quote, building up for a huge product launch. They see the new debt taken on by the company as strategic financing to accelerate growth. Every potential red flag is reinterpreted through a lens of optimistic hope. They ignore the warnings in the risk factors section, dismissing them as boilerplate legal language that doesn't really apply to their company. The hopeful optimist is engaging in motivated reasoning. They have an emotional attachment to a particular outcome, the success of their investment, and they will bend the facts to fit their desired narrative. This is the path of the 99% because it is emotionally comfortable. It feels good to be optimistic and to believe in a company's bright future. It is psychologically painful to confront the possibility that you are wrong. The pre-mortem analysis is designed to be uncomfortable. It forces you to inhabit the world of failure and loss. The hopeful optimist refuses to go there. They cling to their story, often all the way down. When the stock eventually collapses under the weight of the very problems they chose to ignore, they are left bewildered, feeling betrayed by a company they once loved. The financial detective, on the other hand, feels no such emotional attachment. Their loyalty is not to a story, but to reality. Their job is to see the company as it is, not as they wish it to be. This cold, detached skepticism is the ultimate shield against catastrophic loss. The direct financial connection of this defensive pillar is the single most important concept in long-term investing: catastrophic loss avoidance. The mathematics of loss are brutal and unforgiving. If you lose 50% on an investment, you don't need to make 50% to get back to even. You need to make 100%. A 50% gain on the remaining capital only gets you back to 75% of your starting point. If you suffer a 90% loss, as many did on .com stocks, you need a 900% gain just to break even. This volatility drag is the silent killer of long-term returns. The financial benefit of a rigorous pre-mortem process is not about increasing your average returns. It is about cutting off the left tail of your potential outcomes. It's about avoiding the zeros and the 80% losses that can permanently impair your capital base and derail your journey to financial freedom. Consider two portfolios, both starting with $100,000. Portfolio A, run by a hopeful optimist, invests in 10 stocks. 8 of them do well, generating a 15% return. 2 of them are catastrophic failures and lose 90%. After 1 year, despite having 8 winning picks, the portfolio is worth only about $110, $800. Portfolio B, run by a skeptical detective, is more conservative. Their pre-mortem analysis causes them to pass on the 2 disasters. They also invest in 10 stocks, and perhaps their winners are not as spectacular, returning only 12%. But they have no catastrophic losers. Their worst performer is down 10%. After 1 year, their portfolio is worth about $128, $800. The detective's portfolio is significantly ahead, not because of superior stock picking, but because of superior mistake avoidance. Over a lifetime of investing, this difference becomes a chasm. The most important part of winning the game is staying in the game. By making the search for red flags a non-negotiable part of your investment process, you are building a financial firewall that protects your capital from the devastating impact of blow-ups, ensuring that the inexorable power of compounding can work its magic for you over the long run. You have just completed an immense intellectual journey. You've absorbed a framework that took Warren Buffett a lifetime to refine. You've moved beyond the noise and the headlines and acquired the lens of a true financial detective, a genuine business analyst. You now possess the mental toolkit to dissect a company from the inside out, to separate corporate marketing from financial reality, to identify the durable competitive advantages that create lasting wealth, to judge the character of the people stewarding your capital, and most importantly, to spot the hidden dangers that can shipwreck a portfolio. This is not just a collection of tips. It is a fundamental rewiring of how you approach the entire endeavor of investing. You now have a process for building an informational advantage over 99% of other market participants, an advantage rooted not in speed or speculation, but in diligence and deep understanding. But it is crucial to understand that this powerful lens, the ability to read the map of the annual report, is only one part of a larger, interconnected machine. Mastering this skill is a monumental achievement, but the numbers and the words in that report are merely the output, the final symptoms of a deeper cause. That cause is the underlying economic engine of the business itself. Understanding what to look for in a financial statement is a profoundly different skill from understanding the fundamental business strategies and market forces that produce those numbers in the first place. You've learned how to diagnose the health of the patient, but the next step is to understand the laws of biology that govern that health. The video that is now appearing on your screen is the bridge from the what to the why. It is the missing link that connects the skill of financial analysis, which you have just begun to master, to the deeper wisdom of business strategy. It explains the economic principles behind the moats you are searching for. It is the key to understanding not just that a company has pricing power, but quantity pricing power, it has pricing power. It is the next piece of the map, the component that elevates your understanding from that of an informed investor to that of a true capital allocator. Most people will stop here, content with the powerful tool they have just acquired. They will be vastly better off for it. But for those of you who are driven to complete the arsenal, to build a truly comprehensive mental framework for wealth creation, the journey continues. The choice to click is more than just a choice to watch another video. It is a declaration. It is a commitment to continue your ascent, to forge the link that connects all these ideas into a seamless whole. Complete your mental toolkit. Continue your journey.